When I was 22, I made potentially one of the worst financial decisions of my life. I went out and I purchased a $30,000 car, which at that time was a lot of money, almost a full year's income. The car was a Subaru Impreza WRX STI, and I love that thing. It was fast, it was loud, and it was fun to drive. But to make matters worse, I didn't buy the car with cash. Like a lot of young people, I financed it, and I justified buying an overly expensive car at the time on finance because I wanted to get a good credit score. Now that I'm older, uglier, and wiser, I realize that this was an absolute garbage reason for taking out a loan. And that's what I'm going to talk about in today's video. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we are talking about credit scores. The concept of having a credit rating really is more of an American thing than it is Australian. Here in Australia, the lenders want to see three things when you go to take on a mortgage. They want to see that you've got good income, a good savings track record, and they want to know that you don't have any black marks against your credit record. Now, having taken out a loan in the past and paid it off successfully really doesn't carry that much weight when the assessors are looking at your file. Your income is primary in getting a mortgage because at the end of the day, it's your income that services the loan. So generally speaking, the more income you have, the more you can borrow. When assessors look at your income, they want to know that it's consistent and it is reliable. Now, as an employee, and particularly if you're on a salary, this is normally pretty easy to prove because you've normally got an employment contract and pay slips which you can show them. A lot of lenders will want you to be employed with the same company for a minimum of 6 months before they'll give you a mortgage, but there are lenders out there that will do less, a lot do 3 months. And if you're casual or if you get paid a commission structure, this is obviously going to vary a little bit. It's a lot harder to prove your income if you're self-employed, and lenders typically want to see 2 years of financials from your business. And each lender's policies are a little bit different, but a lot of lenders will take an average income over the 2 years. Next up on the importance list is your savings. Now, lenders generally want to see that you have some savings behind you, unless you're using a guarantor, but that's a different story. I'm not going to go into that right now. But they like to see that you've got some savings, and they like to see that you've saved it up over a period of time. And this is known as genuine savings. Now, again, not all lenders require genuine savings, depends on your situation, but I'm not going to go into that detail at the moment. When it comes to savings and cash flow in general, the lender will want to see how you've been spending your money over the last few months, because basically they want to have a look at your living costs and make sure that you can fit loan repayments in there. Now, there are a few expense items that raise a red flag for lenders, so things like gambling. If you have consistent gambling on your record, then this can actually prevent you getting a mortgage. So do yourself a favor and clean up your expenditure in the lead up to getting a mortgage. Lastly, in order to get a loan, it's important that you don't have any black marks on your credit record. Now, there are a number of things that can cause you to get these black marks, things like missing a loan repayment, missing a direct debit commitment, or not paying a fine. But at the end of the day, taking on a new loan and servicing that debt efficiently is going to give you a slightly better credit score, but it's not going to fix the black marks on your credit record. If you want to check your credit record, you can do it online. There are a number of different providers. Equifax, Ilion, and Experian, I think, are three ones that you can use. And if you're willing to wait 10 days for the report, then you can normally get it for free. So don't be fooled, you don't need to take on debt in order to get a mortgage. You need good income, good savings, and no nasties on your credit record. In fact, I would actually go as far to say that taking on a loan is going to hinder your ability to get a mortgage. Because firstly, if you don't pay off the loan before you get the mortgage, then this is going to affect your serviceability and you're not going to be able to borrow as much. If you miss a loan repayment for any reason, then this could lead to a black mark on your credit record, and also it's going to affect your ability to save in the lead up to getting a mortgage. And when I took out my first mortgage, the lender didn't sit there with me and say,
"Mr. Butis, I see that you've taken out a car loan in the past, probably spending more than what you should have been spending at the time. but you made every single repayment when it was due, and that is the reason we're giving you the mortgage today. Congratulations, young man, that was a sound financial decision.
So don't do what I do. Don't justify buying something on credit in order to get a credit score. Because at the end of the day, you don't need a credit score in order to get a mortgage. You should always stick to the golden rule of never borrowing for consumption. But that's it for me today, guys. Thanks a lot for watching. If you like this video, please give it a thumbs up, and I will see you guys in the next one.